Okay, let's unpack this. Welcome to the deep dive, where we take your sources, articles, research notes, and really try to pull out the most important insights.
And today, yeah, we're diving into a whole stack of material comparing two, well, pretty major tools in financial planning, universal life insurance and 401(k) plans.
Right. And these sources, they really get into the weeds, don't they? The mechanics, the good, the bad.
Hmm.
Our job here is to, cut through some of that jargon and help you understand what these sources are actually saying about which one might fit your goals.
Or maybe if using both makes sense, which the sources do touch on.
Exactly. We'll look at the features, the taxes, the sort of long-term picture,
Hmm.
and we're sticking only to the material provided, of course.
Of course.
And, this is where it gets interesting for me. The myths. The sources seem to tackle some common ideas, like, is universal life only for final expenses?
Right. Or is the 401(k) the absolute only way to save for retirement? Let's dig in and see what the sources reveal.
Okay, first up from the pile, universal life insurance. How do the sources actually define this? What is it fundamentally?
Well, the sources frame it as a type of permanent life insurance, but the key word they use is flexible. So, unlike maybe simpler term insurance, it bundles together the death benefit, the payout with the savings part. That's the cash value.
Okay, so death benefit plus savings. It's got that living component too.
Precisely. You pay your premiums, and the sources explain how that money gets split. Some covers the insurance cost and fees, obviously,
Hmm.
and the rest gets credited to this cash value account. The idea is that this cash value grows over time.
And how does it grow? Is it like investing in stocks directly?
Not quite like direct investing, no. The sources say the growth comes from interest the insurance company credits. Now, that rate might be linked to market stuff, partially,
Okay.
but crucially, the sources mention there's usually a guaranteed minimum interest rate. They often cite examples like, maybe 2 to 4% annually.
A floor.
Exactly. And importantly, that growth happens tax deferred.
Tax deferred. Okay, that's interesting. So what are the main features that stand out in these sources?
Flexibility with premiums is a big one they highlight. Within limits, you can often adjust how much you pay. Sometimes even skip payments if the cash value can cover the costs for a bit.
Right.
Then there's the core death benefit.
Mm-hmm.
Guaranteed payout provides that security.
Mm-hmm.
And of course, the cash value growth we just talked about, that accumulating savings piece.
And that cash value, these savings part, can you actually get your hands on that money while you're alive?
Yes. The sources point that out as a key feature.
Mm.
You can typically borrow against it or sometimes make withdrawals.
But, I sense a but.
Well, yes, they strongly caution that doing that, accessing the cash value, it can reduce the death benefit. Or you might end up owing taxes or fees if you're not careful about how you do it.
Okay, so access is possible, but definitely comes with strings attached, as the sources warn. So looking at the positives, the pros, the sources mentioned for universal life,
Hmm.
what are the big ones?
The guaranteed death benefit is almost always listed first. Peace of mind for legacy planning, covering debts, inheritance, that sort of thing.
Yeah.
The tax advantages are key too. That tax deferred growth is valuable. And the potential for taking loans from the cash value tax free up to your basis can be a real plus, especially maybe for higher earners thinking about future taxes.
And that flexibility you mentioned earlier, adjusting payments, maybe the death benefit amount, that sounds like a definite advantage if your financial life changes.
It is. The sources position it that way.
Yeah.
And they also frame the cash value as a tool for long-term saving, maybe supplemental retirement funds or an emergency stash, because you do have those access options, even with the caveats.
All right, let's flip the coin. What about the downsides? What cons do the sources identify for universal life?
Well, higher costs are pretty consistently mentioned as a major one, especially when you compare it to just buying term life insurance or maybe just putting money into a 401(k).
Because you're paying for both parts.
Exactly. You're paying for the insurance and the savings mechanism in one package.
Yeah.
That's generally going to cost more.
Makes sense.
The sources also go into detail about various fees and charges, admin fees, the costs for the actual insurance part, mortality charges, and often hefty surrender fees if you bail out early.
Well, the premium isn't the only cost.
Mhm.
There are these internal drags, too.
Right. And complexity is another drawback they mention. Just understanding how it all works, where the premium goes, how interest gets credited, how fees eat into the value, what keeps the policy active, can be, frankly, pretty confusing.
Yeah, I can see that.
And that kind of links to another big risk they bring up, the risk of lapse. If that cash value doesn't grow enough over the long haul to cover the internal costs, which tend to rise with age.
Or if you stop paying premiums.
Right. Or if premiums aren't enough, the policy can just lapse, you lose the death benefit, and maybe any cash value that was left gets eaten up.
Wow, okay. Losing the coverage is a critical risk. Now, the sources gave an example, didn't they, to show how the cash value might grow.
Yeah, they did. They used a scenario. A 30-year-old puts in $500 a month, and assuming, say, a 5% annual return on that cash value after fees are taken out, the projections showed around $200,000 in cash value by the time they hit age 60.
Okay, so $200,000 over 30 years in that example. And that's money you could potentially tap into for things like, say, college costs, like the sources suggested, maybe without completely wiping out the death benefit. It shows that dual purpose.
Exactly.
All right, let's shift gears completely now. Let's talk about the other side. 401k plans. The sources describe these very, very differently.
Oh, completely different animal, yeah. A 401k is described first and foremost as an employer-sponsored retirement savings plan. Its whole reason for being is to pile up money for retirement using some pretty powerful tax breaks.
So if universal life is death benefit plus some savings, the 401k is really zeroed in on retirement savings. How does that work mechanically?
Well, you put in a slice of your paycheck. Usually, and this is a key difference from UL premiums, before taxes are taken out. Right, so those pre-tax contributions immediately lower your taxable income right now. Then the money in the account gets invested, and any earnings from those investments grow tax-deferred, just like the UL cash value growth tax-deferred.
Okay.
But you don't pay tax on those earnings until you actually take the money out, which is usually in retirement.
Oh, okay. So the tax break is upfront on the contribution, not just on the growth later.
Yeah.
Got it. What are the main features of a 401k according to the sources?
Well, the pre-tax contributions are number one for that immediate tax savings.
Mm-hmm.
Then a massive one the sources really hammer home is the employer matching contribution.
Right, the free money.
Exactly. So many employers will match what you put in up to a certain point. Like maybe they match 50 cents for every dollar you contribute, up to 6% of your salary. That can dramatically boost your savings.
It sounds like a huge advantage.
It really is, based on what the sources say. They also point to the investment options you get inside a 401k, usually a menu of choices, mutual funds, index funds, stocks, bonds, that sort of thing. Lets you potentially aim for higher returns depending on your risk tolerance.
Okay.
And then, of course, that tax-deferred growth on all the investment earnings over the years.
Are there limits, though? Can you just pour money into a 401k?
No, there are definitely limits. The sources note the IRS says annual contribution limits. For 2025, I think they mentioned it's $23,000 if you're under 50.
Okay.
And there's an extra $7,500 catch-up amount allowed if you're 50 or older.
Got it. So let's talk pros for the 401k based on the sources. What are the biggest advantages they point out?
The tax benefits are huge, both saving taxes now with pre-tax contributions and letting the money grow tax-deferred for decades. That compounding effect is powerful.
And the employer match.
Yeah.
You mentioned it, but it seems critical.
Absolutely critical. The sources present it as maybe the single biggest advantage. It's a return on your savings you just can't get anywhere else, like in a UL policy.
And the potential for higher returns through market investing seems like a major plus, especially if you're saving for retirement decades away.
Definitely. The sources highlight higher potential returns. Looking back historically, market investments like those available in 401ks have often averaged higher returns, maybe 7 to 10% a year long term.
Right.
That's generally higher than the more conservative interest rates you typically see credited to UL cash value, which the sources put more in that 2 to 5% ballpark.
Okay, so potentially much faster growth. But what about the downsides, the cons of a 401k?
Well, those contribution limits we just talked about can be a disadvantage for really high earners who want to save even more.
Okay.
And the early withdrawal penalties are a big one. Try to take money out before you're 59 and a half, and you're typically looking at a 10% penalty on top of paying regular income tax on the withdrawal. That really locks the money up for retirement.
Yeah, that 10% hit is a serious deterrent to using it for anything else.
It really is.
Yeah.
Also, market risk is a definite con. Your money is invested, right? So its value can go up, but it can also go down.
Right.
That's great when the market's rising, but potentially painful if you're nearing retirement and the market takes a dive.
Sure. Volatility.
Exactly. And finally, limited control is sometimes mentioned. Your investment choices are restricted to whatever options your specific employer's plan happens to offer. You can't just invest in anything under the sun.
Okay. Now, just like with UL, the sources had a scenario for the 401k too. How did that compare?
Right. Same 30-year-old contributing the same $500 a month. But this time they added in an assumed employer match, say $250 a month, matching 50% of the employee's contribution.
Okay.
And they assumed a higher average annual return, say 7%, because of the market investments. With those factors, the projections show the account potentially growing to around $450,000 by age 60.
Wow. Okay, $450,000 in the 401k example versus the $200,000 cash value in the universal life example by age 60.
Yeah.
Assuming those rates hold, that is a really stark difference.
It really is. It just underscores the potential power of, well, compounding higher returns over decades, plus the massive impact of getting that employer match year after year. That's what the source examples show.
What's fascinating now is how the sources directly compare these two, given how different they seem in purpose and function. What are the key comparison points they make?
Yeah, they really emphasize that the core purpose is the absolute fundamental difference. Universal life is presented as being primarily about the death benefit. The savings part, the cash value, is sort of secondary, focused on lower risk growth, maybe legacy needs, maybe some supplemental savings.
While the 401k is.
The 401k is laser focused. It's designed, optimized, really built for retirement savings and accumulating wealth long term through investing. That's its job.
We touched on tax implications, but the comparison sections really clarify the timing difference, right?
Exactly. Both give you tax-deferred growth, which is great, but UL premiums, paid with after-tax money. Accessing the cash value can be tax-free up to what you paid in, but gains beyond that could be taxed.
Whereas the traditional 401k.
Contributions are usually pre-tax, tax break now, but then all withdrawals in retirement are taxed as regular income.
Ah.
The sources do mention the Roth 401k option, though. That flips it. Contributions are after tax, like UL premiums, but then qualified withdrawals in retirement are completely tax-free, so you choose when you want the tax benefit.
Interesting. Tax break now or tax break later. Okay. What about flexibility? How do they compare there?
The sources generally paint universal life as offering more flexibility day to day, adjusting premiums, maybe the death benefit amount, and, having that potential access to cash value via loans or withdrawals, even with the warnings.
And the 401k.
Less flexible, according to the sources. You've got those strict annual contribution caps. And very rigid rules, plus penalties, about getting money out before retirement age, typically 59 and a half.
Okay. And the risk and return trade-off.
That's a big one. Universal life, lower risk. You've got those guaranteed minimum interest rates, the guaranteed death benefit. But that stability usually comes with more modest return potential, maybe in that 2 to 5% range they mention.
And the 401k is the opposite.
Pretty much. Higher risk because you're exposed to market ups and downs. But that same exposure gives you higher potential returns, maybe averaging 7 to 10% over the long run, based on historical market data the sources reference.
Looking really long-term now, the long-term impact. How do they fare against things like inflation over, say, 30 or 40 years?
That's a crucial point the sources raise. The argument is that the higher potential returns from market investments in a 401k are generally more likely to beat inflation over the very long term. That helps preserve your purchasing power for retirement.
Whereas UL's lower, more stable returns.
Might struggle to keep pace with rising costs over decades. It offers stability, yes, but potentially less growth in real terms. So the sources suggest it really circles back to your goals. Is guaranteed legacy paramount? Or is maximizing inflation-adjusted wealth for retirement the main objective?
And that side-by-side example really drove that home, didn't it? The 401k came out way ahead in projected savings growth, $450k versus $200k cash value.
It did. And a huge part of that difference in the example was that employer match. That's often the deciding factor in those projections, something UL just doesn't offer.
But again, the UL example did provide that death benefit protection throughout the entire period, which the 401k doesn't directly do unless maybe you use some funds later to buy insurance. So different tools optimizing for different outcomes.
Exactly.
Which leads to, I think, a really important question the sources seem to be pointing towards. What are the critical things you, the listener, should be thinking about when trying to figure this out for your own situation?
The sources lay out several key considerations for you. First, your risk tolerance. How much sleep do you lose if your account value drops temporarily? How comfortable are you with market ups and downs?
Okay.
Second, your core financial goals. What are you really trying to achieve? Is it primarily building income for retirement? Is it making sure there's money left for your family? Or is it some combination of both?
And thinking about needing money before retirement seems vital, given those penalties.
Absolutely. Liquidity needs. Do you foresee needing access to funds before age 59 and a half? For emergencies, maybe education, a down payment, that's a big differentiator.
Right.
Your tax situation matters too. How much does a tax deduction today, like with a traditional 401k, help you versus potentially having tax-advantaged access or withdrawals later, like with UL cash value or a Roth 401k? Your current tax bracket plays a role there.
And finally, time.
Exactly. Your time horizon. How many years do you have until you expect to need this money? Generally, the longer your timeline, the more capacity you might have to ride out market fluctuations in something like a 401k.
Yeah, the sources also specifically go after some common myths or misconceptions about these two options. Let's tackle those.
Good idea. Myth number one seems to be universal life is just plain too expensive.
And the counterargument for the sources.
Well, they acknowledge the premiums are typically higher than just buying basic term insurance or only saving in a 401k, but they argue that saying it's too expensive kind of misses the point if you value both parts.
The death benefit and the savings.
Right. They suggest that for some people, getting both the lifelong death benefit and that cash value accumulation in one policy might actually justify the higher cost if both those goals are important. It depends on what you're trying to achieve.
Okay. Myth number 2.
That 401k plans are too restrictive. The investment choices are limited, the contribution caps hold you back.
How do the sources respond to that?
They push back by saying, well, first, there's often a pretty decent range of investment options within most plans, enough to build a diversified portfolio. And second, they keep coming back to the employer match.
That free money again.
Yeah. They stress that the match provides such significant value and growth potential within the 401k system that it makes it a powerful wealth-building tool even with the contribution limits. It's a feature you just don't get elsewhere.
And what about the big one, the sort of overarching misconception the sources address?
It's the idea that you have to pick one or the other, that it's universal life versus 401k.
The either fallacy.
Exactly. The sources explicitly state that's often a false choice. They point out that many financial advisors actually recommend using both, but for different primary purposes.
How so?
Like maximizing your 401k contributions, especially up to the full employer match, should probably be your main engine for retirement savings growth. You leverage the tax breaks and that match.
Okay, 401k for primary retirement.
Right. Then universal life can be used strategically alongside that. Maybe to provide the guaranteed death benefit for legacy planning, or perhaps using the cash value for other long-term goals beyond just basic retirement income, like maybe funding education later, supplemental income, or wealth transfer.
So bringing it all together, what's the final takeaway from this deep dive into the sources?
I think the clearest message is that neither universal life nor a 401k is universally better. It's not that simple. The sources really drive home that the right approach, whether it's one, the other, or a combination, is deeply personal. It absolutely depends on your specific situation, your priorities, your goals.
Universal life really shines, according to the sources, if a guaranteed legacy is a top priority, maybe combined with needing some lower risk, tax-deferred savings that you might want potential access to down the road.
And the 401k is presented as the undisputed heavyweight champion for maximizing long-term retirement savings growth, mainly because of that potential for higher market returns, the upfront tax breaks on contributions, and especially that incredibly valuable employer match.
So using this information from the sources effectively means you need to do some homework. Really assess your main financial objectives. Get honest about your comfort level with risk and how long you have to save. Think hard about whether you might need access to the money before retirement. And consider how your current tax situation impacts the different tax advantages.
And as the sources suggest more than once, maybe talking it through with a qualified financial advisor could be really helpful. They can help you put all these pieces together into a plan that might, quite possibly, use both of these tools to cover different bases.
We've certainly gone deep today, really unpacking these two pretty powerful financial tools based on the source material, understanding the nuances, the pros, the cons, the costs, the benefits of each. It definitely gives you a much clearer framework for building a financial plan that aims for both future security and potential growth.
And this raises, I think, a really practical question for you to ponder as you process all this. If, as the sources suggest, using both a 401k and universal life might be a sensible strategy for covering different goals, but let's face it, most people have limited funds. How would you decide how to allocate your savings between them? If you can't max out both, what factors would you prioritize in making that allocation decision?
Something definitely worth mulling over as you think about your own financial journey.